Hey everyone, so last few days have provided us some good opportunity in the market because volatility is up, markets are down, and therefore we think that selling options in this market will be a good thing because we will get good bang for our buck, meaning we get good premium and good return for our risk, the amount of money that we're putting down. First, I would like to take you through some of my previous trades and see how from making a negative 50% loss on up plus 30% in these trades is just about holding them up, being true to your rationale. So whatever you went in with, you knew exactly what will happen and what you will do when the time comes to adjust. And that's exactly what we did. And I will take you through two trades here, actually three, where we adjusted and then we came out positive and own all three of them. One of them is a break even right now, but the other two are all positive. I've already taken one out. The other two are still on. So let's dive in and then I'll show you exactly how we were at a big loss in an oil trade and how we recovered everything in that. And then the Meta Iron Condor, we were at a loss there as well, but then recovered. And then finally the Apple cover call, which is at a break even right now. So let's go through it. Okay, the first one here is /CL, which is the crude oil market. We started this position. Now I need to go back and I need to find my old positions here. So let's actually do that because it's important that I show you how we started, where did we end up, and then how did we adjust the trades? Because adjusting was the main reason why we came out positive in this one. And it is still on. We'll take it off together. I need to go back about maybe more than that. Go back from the beginning of January. I think that's when we started this. 33 days, order history. Okay, here's the order history, right? This is what we did, which was 15th of January. We sold a strangle. I hope you can see the screen and you can hear me okay. So we sold a strangle there for $1.26. Now, $1.26, we sold the call at 68 and then put at 54. So let's go back to the chart and I'll show you where we were. It's a really good market. We trade this market quite a bit. It's really nicely priced. It's priced to the market. There is no arbitrage going on here. It probably is in the institutional world, but for retail traders, it's a good market. It's an easy market to understand because it trades $10 a tick. So it's really easy to understand. Okay, on 115, it was trading around this mark, which was about $60. Okay, so it was trading at 60. We sold the call at 68 and then the put at 54. So we were $8 out on the call side and then $6 out on the put side. We decided to go for a strangle because the markets were very, very range bound in the middle, not breaking out anywhere. And therefore we went for a strangle here. We sold the strangle for $1.26, $1,260 altogether. Okay. You have to multiply this by 10, by 100 actually for this one. And then another 10. So that's $1,260 we collected for this one. And then we bought the whole strangle back in 15 days on 129. The markets went up quite a bit. On 129, it was trading around this mark. Yes, this is when we made the adjustment. It was trading at 65. So when it was trading at 65, we made an adjustment because we were at a loss of more than 100%. That's what we do. We wait until 100 to 150% loss of our total premium. And that's exactly what we did. We waited. We were up at that mark. Our delta was around 40 or maybe 35-ish on the call side because the markets went up. And we were in a different cycle too. We were in the 19-day cycle. 90 days were left in that cycle. So we were in this one, maybe 27th of Feb, if I remember, or 20th of Feb. So from there on, we moved the spread out into the bigger cycle. You collect more premium, which was trading around 48 days at the time when we made the adjustment. So 129, we bought it back for 274. So that was a loss. Okay. So what's the loss here? We bought it back for 274. We sold it for 126. $1,400 loss times 10 times 100. Okay. 1480. So that's a $1,480 loss because we sold it for 126. We bought it back for 274. $2,740. That's what we bought it back for. Okay. And then the next spread that we sold it here. So this is the spread that we adjusted to in a new cycle. Now, when I say new cycle, look at this. We went into the March cycle, the 17th of March cycle. We were in the Feb cycle here. Both of these trades were in 17th of Feb cycle. We took it off. I would not have created this cycle in the first place, but I was trying to make a video out and then I was trying to teach a strategy. So I took a trade. Otherwise, I would not have taken a trade with less than 45 days for a strangle especially. I would not have done it, but there were 30 days left, 32 here. We took a trade. But again, in hindsight, I should not have done that. Anyways, and then we adjusted the call side to 77, put side to 57. That's what the adjustment was for. So we bought it back for 274. We sold it for 306. We tried to, it did not work. We sold it for 304. So here's your net credit now. We have collected 304 and then 126. $4.30 altogether, and we have paid $274 in debit so far, $156. Okay, so that's the net credit. Net profit here is $1,560, and we will pay some debit today as well to close it. So out of the $156, we can deduct whatever the credit we will pay, and that's what our P&L will be. But the P&L year to date is the main year. This is a very important one. This shows you the overall P&L year to date, which is what we are up. We're up $340 in the sticker. And if we were to take this out today, close this, buy back this triangle for 130, that's totally fine. Let's just try and close it at 131 so that we get done with. Okay. So our net credit was, it got filled at 130. Okay, good. So our net credit was 156. Now we have paid 130 to close this. 260 is what our net profit was in this trade, plus some of the profit in the previous one. So our P&L year to date is positive 340. We went out to collect $1,260 initially. That did not work out. So we made an adjustment. When we made an adjustment, we sold it for a credit. We bought it back for a debit, and then we sold the whole spread for a credit in the next month out. Totally fine. We sat on it for another 15 days. We made that adjustment end of January. Today is middle of February almost. Could have sat on this more. But again, I wanted to show you the whole enchilada of the trade, the whole life cycle of the trade. Like, how do we make adjustments? How do we go from a loss to a profitable trade? That's the whole idea. Okay, that's the crude oil. If you have any questions, just drop it on in the comment box and I'll answer everything that I can. Next one was our Apple trade. We had a short call here. Again, this short call is now also breaking even. Totally perfect. That's the scenario we want. We want a break even or a profitable trade. However, we sold it for $256. Okay. In the last couple of days when Apple was up, it is down right now. When it was up to $277, this thing was trading at $10. So we had an $800 loss. Again, no panic there. Just sit on it. It was a perfect scenario because our long stock was going up. Our short call was like going down a little bit, but that was totally fine. If I were to make an adjustment, I would have made an adjustment maybe today or Monday. And that's what we are out here to do today. So Apple is trading at 258. It has come down from its 277 level, which is where it was. We have 35 days left in this cycle. We are trading around 23 delta, which is totally fine. Now, what I'm going to do here is I'm going to move this short call out to the next cycle. So what is the next cycle here? It's a good opportunity to adjust the trade because the market has been up. And then when it's up, you get a better structure on your call side, meaning you can go further out on the call side and sell a call to make it, more worth, your risk. So I'm going to go into this 63-day cycle now, and I'm going to select a 25 delta strike, which is 280. So from 275, I'm going up to 280, or maybe even 275. Let's stick to 275, but let's go in the next cycle. It is one concern though. So we're not getting enough room on the upside. It's trading at 260. It can easily go up to 275 from here, 280. So what I'm thinking about is there's enough days left in this current cycle. So how about if we just stay here and then think about an adjustment? If again, this thing keeps going into the money for us or start losing us money, it is not losing us money right now. It's a flat trade. It's up $131 today. Totally fine. And then I would say, let's just stick to it and then let's just write it out. By write it out, I mean, write out these days, number of expiration days. From 31 to down to 25 maybe. When it's at 25, we will think about making an adjustment. No gain, no loss. The other trade I took, I don't know if you were following my video, the other one I took was in Meta. So if you look at Meta, we went in with an Iron Condor. So when I say Iron Condor, I mean, we sold the call side on the day. So 122, we sold the call side. I'm looking at the filled orders. These are the two filled orders. Okay, great. So you need to look at these ones, okay? The top two lines, the two filled ones. We sold the put spread for 170. We sold the call spread for 130. So that's a total of $300 we collected. Okay. When I bought it back in 7 days, because it went up so much. Okay. So there was an earnings in between. Again, should have been careful here. We don't like to take earnings risk, but here was the earnings. It was a big pop up and then it started reaching a call side. So when it did that, I took the put side off because the put side was completely max profit. So I took that off. So I took the put side off for 27 cents, sold it for 170, took it off for 27. So that's a good $1.50 profit almost. And then on the call side, I let it run. So I did not do anything on the call side because it was still not breaching the call strike because our call strike was sitting at 750. The stock was trading about 735-ish. So it still had some room. So I did not touch it. And then it started going down. See Meta. So it went up to 7 something, right? Look at this, 750 was our strike. It went up almost there. And then it just came straight back down. So at this point, I took off the short put spread because it was completely max profit almost. And then here, I let the call spread sit on it because there were enough days in the cycle. The reason why I let that one go, let the put side go because it was completely at max profit. I think the cycle was this one, 20th of March, if I remember correctly. Yes, 20th of March cycle. So it had enough days left in the cycle. So I did not want to move the spread out to another one because that's enough days here. So I took the spread out on the put side. And then on the call side, I left it on and then it just roared it out, meaning it was a big earnings pop. Because I wasn't convinced with the rally, I just stayed on it, short delta, left the call spread on, and then I took it off 4 or 5 days ago. Okay, I collected 130 on the call side, and then I bought it back for 108. So not enough credit, not enough profit there. But again, overall, the trade was a profitable trade. If I have left this on today, it would have been made more money. But overall, it was a good trade, about $170 of profit. That's a good return on our investment because we went in with $700 down. So our max loss was 700 and we made about 200, I think maybe a little bit less than that. So 200 on 700, that's a good return. Okay. And that's the reason why we trade these mechanically, meaning I don't like to panic about these things because when we go in, we know exactly what we are going to do when the markets will go against us. And that's exactly what we did. We waited. We wrote it out. We did not panic. We just came out positive, all these trades. Again, if you want to know more about these things, I run a 5-day trading challenge. The next one is starting on February 23rd on Monday. It's a 5-day event. So you will learn every single day. I'm going to teach you 3 different strategies you will walk away with. It starts on February 23rd, runs till 27th, 3 p.m. Pacific every single day. The price is $149. There's no reason to hide the price. It's just there. If you like it, you push the button. If you don't like it, you move on. You go find something else. Okay. Here's the game plan. We go into the theory of this, why we sell options, what's the math behind it. So I show you a couple of different things. Why do we do it? And then the following 3 days are actual strategy implementation on the platform. I take you through my strike selection, the whole setup, the whole enchilada of how I select trades, how I select the strikes, and what do I do when there's a breach. So what I mean by breach is when the markets go against you, what do you do? Going into these trades, the setup looks perfect, right?
Day 3 unlocks the wheel. Master how CSPs transition into covered calls with real examples that make it click. Day 4 elevates your game with credit spreads and iron condors, complete with proven management rules for scaling income with defined risk. Day 5 transforms zero DTE trading from intimidating to systematic. You'll get a complete checklist for disciplined same-day income generation. Walk away with the strategies, rules, and confidence to trade like a pro.
It's 100% money back. If you don't like it, no hard feelings, you just email me. You do need to be on the calls. So every single day, I want to see you on that call for 1 hour. And you don't need to turn your camera on, but you have to attend the call where I'm teaching all this. And then after 5 days, if you still don't learn anything, that's totally fine. You just email me and I'll give you your money back. Go onto this page. I will put it in the description and I hope to see you in the next one. Have a good one. Thank you very much for watching. Bye-bye.